We have here with us DJ Wu, who is my professor at Georgia Tech. He's a professor of information technology management at Georgia Tech, and he got a PhD from Wharton, and he's got a bunch of publications in a whole bunch of different journals and such: Management Science, Journal of Management Information Systems, European Journal of Operations Research, Design and Support Systems, etc. So without further ado, DJ Wu.
Okay, thank you. Can everybody hear me? Yeah, thank you. See, the incentive for me to visit Google is actually for my teaching. See, I'm teaching these electronic commerce classes. So we have lots of MBAs, and Google is a must-teach case. So I want to come here for a site visit to check out whether you have free lunch here or not. It's really for the free lunch, and also to learn how to play Lego. But then I sent this email to Sean. He said, "Can you do a talk?" I said, "Gosh, what should I talk?" So then I sent him 3 topics, and he actually maybe checked. I heard that he checked with Professor Hall-Warren, and then says, why don't you pick 2? Okay. So actually, I'm going to do 2 talks here, but it's work in progress. It's an ongoing project at Georgia Tech. So I like to keep the talk very informal and interactive. And you can ask any questions for me. We don't have any confidential questions. It's open research. This talk it's about pricing real options contracts in capacity exchanges. It's a joint work with Professor Shijie Deng of the School of Industrial and Systems Engineering at Georgia Tech. So the motivation of this research is really the internet. Okay, internet has really revolutionized the definition of a market, and in fact has created many new electronic marketplaces. Google is a must-teach case, and there are others. I won't call them the rivals of Google. We have a proposal for you. Why I'm here is I want to discuss with you. There are a lot of innovators here. So here's the idea. We have been thinking for a long time. Okay, so what's the next? So we have all these new markets. What's the new thing we can do? It's a smart market for capacity trading. And the idea is very simple. Okay, the idea is, I want to offer capacity as an option. Okay, it's different what they're doing now. Okay, I like to use this example as imagine, just imagine, Dell, okay, is going to source in for memory chips from a supplier in China, okay? Just imagine this company called Foxconn, okay? I'm not sure this is really true business, but here is a buyer and the supplier. Say, I want to buy memory chips. For the moment, what they do is they sign advanced contracts. But I have to buy, right? For example, let's say a particular contract that says 1,000 units of memory chips, okay, for me to produce another Dell computer. Then, how much should I sign in advance with my supplier? If I sign a lot in advance, but in the process, things are changed. I don't know actually my market demand, okay? For January 2007, could be high, could be low, right? And I don't know what Intel is going to do. Silicon Valley is keeping innovating. So what if during the process, they have a new release? For a particular set of, the DRAM exchange, okay? So if you have a new release, what do I do? Okay, with this huge stuff I signed, I have to buy. So therefore, the idea is, what if we don't actually sign a contract for extra stuff in advance? How about we sign this capacity as an option, okay? And by next January, I could exercise my option, okay, if I do need those memory chips, okay? Otherwise, I could not exercise. I can choose not to exercise. So that's the basic idea. So what I want to propose is a continuous auction of those capacity options. It's an auction of options. So that's the basic thing we're doing. And why this is new is because right here we have 2 markets, okay? The first market is we call the contract market or options market or the advanced market. Say a year ahead, right? I'm going to contract for the capacity and for memory chips. And also I have a spot market. See, on the day, let's say January the 1st, 2007, when I need the stuff, I need the memory chips, right? So there's a price right there. There's a spot price. So I want to integrate those both prices. So that's the beauty of the internet. So previously, it's separated. So now we actually have opportunity to integrate those two markets, right? The forward market or the options market and the spot market. Okay. The way I'm going to integrate them is using this idea called the real options from finance. So that's the basic idea. So we're going to continuously auction those capacity options, okay? And those options, is really a real options contracts that can connect the forward market or the options market and the spot market. And so what's novel in this talk, or our contribution is we actually have a continuous time model of capacity options trading in electronic marketplaces. So if you already know the stuff, you can go. That's basically, that's all I'm going to discuss. This is, it's a precise example, okay? Let me again using Dell as an example, but it may not be true, okay? I'm just, like to use some names to give you the idea. Suppose I want to buy, say, DRAM memory chips, okay? Say for the moment, okay, they could 90%, of these deals, contracts, say they're going to give to a long-term or incumbent supplier. Okay, so this is somebody they have been doing business for a long time. They know, and for the rest of say 10% of those capacity, okay, or they're going to get it from the spot market or from exchange. Okay, it's a very small percentage, roughly 10%. The reason is there are other concerns. In my second talk, we'll talk about those non-price attributes like quality, and there are also relationships, long-term relationships. So the trend in that industry right now is they're called structured sourcing. What they do is so they want to be able to hedge price, because I don't know the price next January. So I want to be able to hedge the price. I also to be able to hedge my shortage. By the time I need it, I want to make sure I can get it, and I also want to save cost. Okay, there are three goals. So you have to satisfy three goals: hedge price, hedge risk, and also save cost. So we're going to claim, we have a model, we have a contract actually can help firms to satisfy all three criteria. This is another example is about electric power market. Same thing, but I'm not going to go over. So this is the thing we have been working with my advisor at Wharton, Paul Kleindorfer. For over a decade, but the similar idea. So the commonality is the following. Say I want to spend some time to really lay down, the problem here. Okay, if I can't tell you the problem, I'm done because then you can solve it. So the problem here is, again, we have two markets. So you have this contract market. Okay, let's just assume it's a year ahead. Okay, I'm going to sign, with the suppliers, say in China. Okay, for say a large amount. See, those are billion-dollar contracts, right? So it could be a year ahead, okay? Then we have a spot market. Depends on what we're talking about. Electrical power is actually 10 ahead of use, okay? But for memory chips, we can be just on a day. So you have two markets, the contract market way ahead, and then the spot market. So what we're proposing in between, so you can trade. Let's say, again, let's thinking about, let's say, who is selling this kind of contracts? Say, for example, it's TSMC, okay, Taiwan Semiconductor Manufacturing Company. So they are selling you, let's assume that's Dell. So tradable capacities or selling into Intel, those tradable capacity options, okay? But in between, you may trade, okay? And see, the events are the following, okay? See, first of all, the suppliers, they're going to bid, okay, the contracts and also the capacity, okay? Suppose I have a big capacity. Let's make it simple. Let's say 100, okay? But I don't have to tell you I can sell 100, right? So I have to decide, see how much to post, to announce, so that because if I post 100, you may take 100, right? But I may save some. I may withhold some of my capacity because there's a trading going on. So we are talking about the business. It's on a day, okay? So there's plenty of rooms, say for you to play. Okay. So the suppliers, what they do is they're going to bid those options contracts. The options has two parts. Those are standard. The first part is a reservation fee. Second part is execution fee. Okay, you first have to pay, say TSMC, right? Say let's say $2 per unit. I'm just making that to reserve the capacity for you. Okay, and on the day, so if you want to actually exercise, say buy this, say you pay some additional execution fee or striking. This is also called the striking price. Let's say $1 or $2, okay, extra, okay, to actually use the stuff. But if you don't want to exercise your options contract, you don't have to pay execution fee. And they have to decide, say how much capacity to actually post. Okay. Then what the buyer is going to decide is, say whether to buy those kind of options, say and how many options, okay, to contract in advance. So that's the buyer's decision. And in the process, they could update, the information. They don't know what's going to happen, say, on the day. They don't know, say, for January, say, what the market looks like. Okay? So in the process, both parties, both the supplier and the buyer, they're actually going to update the information. Okay? Then they're going to adjust their decisions. How can this the supplier adjust? Because so he's going to adjust the reservation fee, execution fee. Also, he has to control the rate of release of the capacity. It's different way is, again, how much capacity to post. So you can think about every day, okay, over the time. And the same time is the buyer that have to thinking is, say whether should I buy or not, okay. Then also, so you have to thinking at which rate, okay, to buy, yeah. The supplier is keeping posting, so then you have to decide whether to buy or not over the time. So that's see in between what happened, okay, and they can trade here. They can trade. The big framework is they can trade. Yeah, buyers can buy more than they needed, then they can sell back in, and they can trade because they have different beliefs, right? About the state of the world. In all different suppliers, different buyers, say they have different needs. So they may discover, say which market is selling where. Say what, these firms, they are global firms. Say a particular product, and if not selling well here in Silicon Valley, may sell well in Atlanta, or even better in China. So they actually, they can hedge actually across the world. So that's why you have trading going on. Then on the day, the supplier decided whether to sell residual capacity. They may have residual capacity, right, on the spot market or not, okay? And the buyer has to decide. They're going to decide, okay, how much to exercise. So far, he has accumulated, right? The buyer accumulate all these capacity options, okay? Then on the day, so you have to decide, okay, how much to exercise, from all this, so you pay the reserve capacity, and also how much to buy from the spot market, so you don't have to buy from those. Those are options, right? You could actually source entirely all your needs, right, from the spot market if the spot market give you a good deal. So are you with me? So that's the whole timeline, what's going on. And so I'm going to present a model that can nail down the idea. It's only one supplier and one buyer. Okay, let's say how can we solve this problem? Okay, yeah. Any questions? Yeah, this is the basic setup. That's the problem we are looking on. Before we actually do this continuous time, let's say what if there's only 2 periods, okay? Suppose you're not allowed to trade, okay? You can contract in advance, a year ahead, okay? And you have 2 markets contract market and the options market, what's going to happen. Okay, we actually solved this problem early on. So it's with actually several researchers. One is with Professor Shijie Deng from I think he's now at Hong Kong University. Then Professor Paul Klandorfer. He's now at INSEAD. What we do is, see, in these two markets, let's again take a look. Okay, we have options contract. You have the reservation fee, okay, execution fee. And this capital Q is the optimal contract the buyer is going to reserve from your supplier. And we also have a spot market price, PS, right there is open. And we have the mean of the spot market price, and we also have a measure about spot market liquidity. So this picture actually tells you, okay, the solution for this two period is actually very simple and very intuitive, okay? And what shows up here, say if you travel north, is the price of the real option, okay? And if you travel east, okay, tells you is the execution fee price. We did a transformation. So this transformation is because these are options. So on the day, what you're paying is the price, is the minimum of the spot price, and your execution fee, right? So you're gonna pay whatever is lower. Okay, so that's the little notation, is a transformation. So once you do that transformation, the optimal solution is those straight lines, say 45-degree lines the other way. See, then we can tell you when these guys, they have incentives to trade, when they don't, okay? So all you have to do is you do this index, the reservation fee plus the effective price, this we call this effective price, okay, equals to the mean of the stock market price. You have this 45-degree line. So if any supplier is going to post a contract, okay, the buyer does the calculation, is this bigger than the mean of the stock market price, they're not going to buy, because I'm going to wait, right? See, I'm not going to pay more than the mean of the stock market price. So there's a no trade here. And on the other hand, see, the suppliers, they also need some incentive to participate. They need you to pay me something upfront to reserve capacity for you. So otherwise, I can wait. See, why should I sell in advance, okay, to you, to the buyer? So therefore, it's only that little triangle area, okay, is the trading area. Okay, so both parties, say they have incentive to trade for capacity options. And this line, we actually can tell you exactly what's the optimal reservation for the buyer. It's actually very simple. Is this capital U is the utility function, okay? This U prime is the buyer's willingness to pay, right? You plug into this equation, you solve this one, it actually gives you the optimal capacity reservation for the buyer, okay? So, then the supplier is going to take this into consideration. Okay, this is typical game theory. Okay, and then they say, what should I set my optimal contract? Okay, and we prove that the optimal contract is actually for the supplier to tell the truth, to actually charge the production cost. Okay, execution fee. So set the execution fee exactly equals to their marginal production cost. Don't make money in that striking price setting. Rather, making money by raising your reservation fee. So that's so that's like an overview of previous literature what we did. So then this point is actually the equilibrium point. So and that's the prediction. Say in the forward market, say what's the price the supply is going to set for reservation fee, execution fee, and how much the buyer is going to reserve in advance. And on the day, see what the buyer is going to do is they're going to, it's simple, it's going to compare the spot market price versus execution fee. Whichever is lower, he's going to do that, okay? And if spot market price is higher, then they're going to exercise their options, okay? And in fact, they're going to use all the capacity they have reserved. So that's what we did in this two-period model. But in order for us to actually to do this proposal to have an industrial exchange to trade, we need to solve this continuous time model. Okay, so therefore, in order for us to actually to go ahead and set up an industrial exchange for capacity options, we need to answer the following questions. The first question is the same, like this 2 period, okay? So what is the buyer's optimal sourcing strategy? Taking this into consideration, what is the supplier's optimal, okay, selling strategy, okay, or bidding strategy, right? In how the supplier should bid, right? Yeah, you can imagine there's an electronic bulletin board. So how should the supplier bid? And in the equilibrium, okay, and what is the price of capacity options? And how does it compare with financial options? So because New York Stock Exchange, we all know that. Okay, how does it different? We also have Chicago Mercantile Exchange, right? So therefore, how do you compare the price of real options versus the price of financial options, right? How do they differ? Okay, when do they converge? So we need to make a linkage, right, to this intellectual heritage. Okay, then how does this 2 markets price co-move, right? Now we have 2 prices, right? We have the spot market prices keeping moving, okay, stochastically, but you also have this contract price, right, keeps going, right? What's the relationship between these 2, right? So how do they co-move? So we need to answer those questions. And also, from the operational point of view, they want to ask the question is, okay, so what if the spot market price is really volatile, right? Okay, so then, is this capacity options more valuable? See? So intuitively, you think that's true, right? So why would you like to buy capacity options, real options? Right, if there are a lot of risks, right, in the spot market, in particular when you have a huge volatility, okay? So yeah, that's the intuition we need to check whether it's true or not, okay? The second thing is, so if I sign this, I'll be right with you, if I sign this, okay, way ahead, okay, is that value higher to the buyer or not? So this is called time to delivery, okay? So yeah, those kind of capacity options, okay? So is that, say the earlier I sign with the supplier, and the more valuable to the buyer or not. Okay, intuitively you may think it is true, but we need to check it out. Yes?
Yeah, two questions.
Is that confidential or not?
Two non-confidential. Okay, good. In the model, are you assuming any storage capacity where you can say, stock up when the price is low and kind of use that to ride through?
Excellent question. What I'm thinking here is a non-storable. Okay, say if you repeat the question. Yeah, the first question is, do I assume storage? Okay, if I cannot sell the stuff, can I store? Okay, in this particular model, we don't assume that. Thinking about electrical power, it's hard to store. So in particular, so there's we are starting perishable goods. Sorry, perishable goods. Okay, it's non-storable. Okay. Mm-hmm. Second question.
And the other question is not relevant given that first answer.
Oh, okay, yeah. But you actually can think in storage as a special case of a perishable. Okay, basically the holding cost is extremely high. So yeah, but the feature of the semiconductor is you don't want to store. Yeah. Okay, so those are the questions we're trying to answer before we actually do the proposal. And this is again the timeline. I believe I already went over it. This is just the formal definition. It's the same thing like that color picture I did. So I'm going to skip it. Again, the idea is the call option on capacity, so I'm going to skip it too. So this model it's a simple one, 1-to-1, one supplier, one buyer. The seller is the von Stackelberg leader, and the seller has a fixed technology. Little b is production cost, okay, or marginal production cost. Capital K is the capacity, okay. It's the Intel's plant, okay, for foundry, okay, it's the big one. You can think in power plant, they have a capacity. In the short term, you cannot change because once you build that big plant, that capacity is fixed. Okay. So both guys, they're trying to maximize revenues, okay, or profit. To illustrate, our model, we're going to assume the execution fee is truth telling, okay, because we have proved. I believe it's also true in the continuous time. So but let's just assume, okay, you're not going to make money execution fee. Now, therefore, there's two things the seller can control. One is the price of the option over the time, and the second is, how are you going to release? Okay, how many capacity you want to post over the time? Okay. Buyer is a utility maximizer. So over time, he's accumulating his options. Those are actually not the number of memory chips he already purchased. It's actually, those are options. He has the right to purchase in them, but he has not even purchased yet. So basically, he's not storing anything. He simply purchased the rights, okay, on the day to use. But he's not going to store all those memory chips, in his own places or warehouses, okay? The spot price, nobody can control. Okay, we're assuming it follows a stochastic process. Nobody can control the stock market price. That's like a global, the market price for memory chips. And what we're doing here is really we're trying to extend the early work we did for 2 periods to the continuous time. Okay. We actually have a formulation for the problem. I'm going to skip it, unless you really want to. But I want you to, close your eyes. But but we actually, you have to form this continuous time model for the buyer, and you actually can solve it. Okay. Let me tell you what the solution looks like. Okay. Yeah. Turns out the solution is a bang solution. The buyer is going to buy whatever you're going to post on the capacity. At the time, at the time of the day you want to actually to use it, is exactly the same decision as the earlier paper we published. So that's the solution. The seller is going to take all this into consideration. It's a very hard problem. So this problem, because I don't want to go over, because Shano only give me like 20 minutes, 30 minutes. There's no way I can finish. Let me tell you, it's very hard. Things the whole world is going to watch, we invite mathematicians to work on this problem. It's a very hard problem. We actually checked with top mathematicians. It's a hard problem, but we have some ideas. For the special case, we believe we solve it for one seller and one buyer. Okay, with also assuming that execution fee is, is going to be the same as your marginal production cost. Okay, so the seller these are standard. The solution approach is actually standard. Okay, and what is the seller's optimal pricing? This is a key thing I want to tell you. See that it has connections. So this actually, the price is that formula. That formula. Let me explain to you what's going on right over there. It's the pricing of real options is the difference between two call options in the financial options. See right here. So the first term right there, you may not realize that, but for those of you who study finance, is actually the classical Black-Scholes formula. See what this proposition says is that, so you cannot plug and play. See, the price of a real option is the difference of two options. It's actually lower. It's lower than this Black-Scholes formula. So this is a key insight, what we discovered. So it's always lower. So the first term is BSM, and there's a second term right over there. And what the seller want to do is they want to price the options exactly equal to the buyer's marginal value of capacity. And we can prove there's a very nice thing. The optimal options pricing process is actually it's a super martingale. But the key thing is the seller is going to price exactly the buyer's marginal valuation of capacity. That's why, so they're going to post exactly that, and the buyer is going to take exactly that. So the optimal, this one is actually hard. Okay, we think we get it, but I don't put it as a proposition. I put it as a conjecture to be careful because it's a videotaped. Again, I want mathematicians to work on this. The optimal rate of options, we believe, is what it's going to be. It's at the it's basically it's at the maximum rates such that the marginal revenue equals to marginal opportunity cost for the seller. So that's the idea behind it. So we haven't been able to formalize it. I haven't had time, because I was not prepared to give this talk. Put this together, you actually have the equilibrium solution right over there. So I believe we get the major things point out. Okay, this is the solution to my early questions. Now, what if? So we're assuming this process is geometric Brownian motion. Okay, that's standard. Okay, we plug into a specific process to see whether we can solve it. So you can see that. So the first one is, the question is, so what's the relationship between the price of options versus the spot market price? Okay, what has shown here is, so it's the same direction. The first one, the same direction. So if the stock market price is higher, okay, then your options contract is also higher. That's intuitive, right? Also, if the buyer is willing to pay more, right, that's also intuitive, right? If the buyer's willingness to pay increases, then it can also increase the price of the options. So that's intuitive. So there's no surprise over there. The surprise is the next one, the next two. And what's showing up here is, so the first one is the volatility, see right here. So you see as the volatility of the stock market increases, see the price of the real options actually decreases. This is very counterintuitive. It's different than people think. This is what's new here when we price in real options. The second thing that's also surprising is as the time to delivery, so this is increases, actually the price of the real options also decreases. Okay, so this is what's surprising, counterintuitive. So again, the point we're trying to make in here, you cannot do plug and play. You cannot say, I just learned this. In finance, I opened the textbook and I want to set up a B2B exchanges for capacities, it won't work. So we have to show you, even for the simple cases, say you have all these, surprises. So basically, see what I have been done is we set up a theoretical framework. That's the first step towards the implementing of our proposal. Okay, yeah. Again, you may ask me a question: who wants to do it? It's Singapore. Singapore Exchange actually, at one time, declared. Actually, to the whole world, they're going to do it. Okay, in 2004, but then they didn't do it. I went to their website, double checked. They may correct me if they watch your videotape, but I did went to Singapore Exchange. They pulled it off due to other priority. Then Taiwan Exchange also tried, okay, to actually set up exchange, okay, to again trade options contract for memory chips. They made this, explicit. They even put it in their annual report, but they didn't do it. But again, so I don't know the exact reason. They may have other priorities, but I think we need to solve all these problems before we go ahead to trade that, because it's different. There are also other firms, I won't name it. they had business for a little while, okay, in this country. But they were simply borrowing exactly from financial trading, okay. You deposit, okay, then we trade. I'll do a margin call, yeah. The point I'm making here is, it's given all these new things here, and we need to sort out, see the unique things, okay, about trading of these real options before we're actually going to do it, okay. To me, it's not surprising they had a business for a while, but not anymore, okay. So therefore, but I think Google can do it, right? But you have smart people. Then the rest I actually already talk about. But the key point is this is the first step. We have a theoretical framework. We have this foundation laid out. Right now, I'm hoping one firm we're actually going to do it. Yes, sir.
Could you talk about the generalization to the case with two buyers where there's a constrained under-provisioned capacity so that it's a tight market?
Yeah, it's already, I wrote a paper with, again, Paul Kleinhofer that published in Management Science 205. We actually solved the case of a multiple supplier and a multiple buyer, and with capacity constraints, but again for 2 periods. And for continuous time, it's very hard. We haven't solved yet. So, but for 2 period, we already solved.
Well, I guess one of the questions I have is with respect to, for instance, volatility of spot price in a constrained market, I can kind of intuit that curve for the single supplier, single buyer, where there's no implicit availability constraint. But where there would be multiple buyers, I'm not sure that that would necessarily. That seems to defy my intuition more in the case of multiple buyers with constraints than it does with single buyer.
I think you have an excellent point. Thank you for your question. Let me emphasize again. So what we have here, the contract market is it's a small market. Okay, the contract market is invitation only. So it's basically I'm keeping using Dell, but forgive me. So Dell only do business with a small subset of suppliers. These are they call long-term suppliers. Okay, like say 6 people. Okay, 6 firms. Okay, so it's it's constrained, and the small market is open to the whole world. Okay, the small market say right here, so nobody can control. So that's one of the reasons why we have this result. Again, we are not trying to solve general equilibrium. Okay, here we're trying to solve a specific problem for a specific industry. In particular, we are interested in those perishable goods. Okay, like electrical power, like memory chips. It actually fits into our model is trying to fit into the business setting. Okay. Yes, you can actually make it very hard, general equilibrium. But then it's hard for me to show what's my contribution because way back we have Nobel laureates. They already solved the problem. Thanks. Yeah. You have a question? Okay. So then we're done. Yeah. Okay. Yeah. Thank you. Yeah. Make sure you take this. Yeah. From Georgia Tech. Okay. Yeah. Yeah, feel free to go. Should we move to the next talk? Yeah, take a break.
Does anybody have any?